Global Finance, Topic 8A, Carry Trade, specifically the Yen Carry Trade by Lou Gaddis. The objectives of this podcast is to understand the risks and opportunities of a carry trade, compute the profits from carry trades, and relate carry trades to interest rate parity and covered interest arbitrage. A carry trade is a trade in which you borrow a low interest rate currency, or specifically borrow in a country whose interest rates are very low, and then invest in a country whose interest rates are very high, or at least higher. Throughout the 2000s, one of the most popular trades in hedge funds was the yen carry trade, when yen interest rates were less than 1% and U.S. Treasuries were near 3%. So here's an example of how a yen carry trade would work in those days. You'd borrow $1 million from a Japanese bank and say you're able to borrow 1% for 1 year. You now have $1 million at an interest rate of 1 million yen at an interest rate of 1%. You immediately sell your million yen, and if the spot price of the yen is $100 per yen, you can buy $10,000 for a million yen. You immediately invest the $10,000 in 3% treasuries, and in a year's time, you'll have $10,300. At the end of that year, you also have to repay your loan. Your yen loan is a million yen at 1%, so that's 1.01 million yen you owe. At an exchange rate of 100 to 1, that'll cost you $10,100. So your borrowing costs are $10,100. The return of your US dollar loan was $10,300. You just made $200. And then you could scale up this investment as you continue to borrow at 1% and invest at 3%. The effects of this trade in the 2000s were twofold. One, it kept the yen's value suppressed. So you think about at the peak of the trade, there might have been $1 to $2 trillion borrowed in yen and brought to other markets like US dollars to buy treasuries. The effect is to keep the yen low, as every day new bankers would call Japanese banks, borrow yen, and then immediately sell the yen and buy dollars, or sell the yen and buy euros, or sell the yen and buy other currencies. And the effects of all that selling of yen was it kept the yen depressed. The second effect was it created a systemic risk in the entire financial system. There's many articles coming out when the yen started to appreciate, saying that the world could fall apart, at least the financial world could fall apart as hedge funds start to take losses. And the reason they would take losses is if they want to repay their yen loans, they had to first buy the yen and then send them back to Japan to pay off their loan. If the yen started to appreciate, it would cost them more to buy the yen, and their trades would be unprofitable. So that's the major risk of the yen carry trade. It's an appreciation of the borrowing currencies or the borrowing country's currency. So here's an example. And first, let me do one thing. In the last example, I said U.S. interest rates were 3% and Japanese interest rates were 1%. If that's the case, we can use interest rate parity, a theory we did in last section, that says the spot price in year 1 will be the spot price year 0 times the relative interest rates in the two countries. If we're looking at what should the spot price be for the yen next year, you take the current value of the yen per dollar times yen over dollar interest rates. So the yen should have appreciated from 100 yen to 98.058 yen according to interest rate parity. And notice this is an indirect quote, so when the exchange rate goes from 100 to 98, it's roughly a 2% appreciation of the yen. Now let's go back to the last example. If I borrowed 1 million yen, converted them at the spot price to get $10,000, and invested them at 3%, I'd have $10,300. However, there's no reason why the spot price has to stay at 100. When I borrow yen and pay back 1.01 million yen, what if the spot price rises according to our theory, interest rate parity? Well, at that new exchange rate, 98,058, you can see the cost of our loan is 10,300. So if you look at the profits, they're exactly zero. So according to interest rate parity, well, if interest rate parity holds, there should never be a profit from a carry trade because countries with low interest rates would tend to appreciate because we assume they have lower inflation. So in the example here, Japan had 1% interest rates, US had 3% interest rates. According to IRP, the yen should appreciate by roughly that difference of 2%. So when I invest my proceeds of the borrowing at 3% and I pay back my 1% loan, but the yen is 2% more costly, effectively I got a 3% loan in dollars. Now this is a surprising result that if the yen interest rate or if the interest rate parity holds, there is no profit in a carry trade, which actually leads to another interesting finding, is that alternative proof to the theory of interest rate parity is an arbitrage argument, specifically a no arbitrage argument, meaning that as long as there's a chance for arbitrage, traders will buy and sell currencies and borrow and lend dollars to such a point where all the arbitrage in the system is gone. And that point is where the forward price reflects interest rate parity. So one thing always bothered me about interest rate parity is that assumptions. The assumption that when you observe interest rates, you're observing differences in inflation, meaning the real interest rates are always the same. So this is another way to prove interest rate parity without having to make an assumption about real interest rates. Now, a successful carry trade then would be to try to find a currency that has low interest rates, a country with low interest rates, and their currency will not appreciate according to interest rate parity. So there's some kind of structural impediment to the currency appreciating. And usually what we would think about is maybe the government's involved with trying to manage the exchange rate, keeping it stable or pegged. In that case, that could be a profitable opportunity. Now, in the yen carry trade, the thing that makes it interesting is one possible reason why the yen carry trade worked is not because the government was necessarily trying to manipulate the exchange rate. It's that as new money poured into the yen carry trade, it kept pushing down the yen and not allowing it to appreciate. So the demand for the yen carry trade and the continued use of the yen carry trade is what made the yen carry trade work. Now, the yen carry trade does not just have to invest in treasuries. So a risk-on carry trade is one where you borrow money where it's cheap and hopefully the exchange rate doesn't go up. But then you invest it in not just U.S. treasuries, you can invest it in U.S. stocks or risky U.S. stocks, say tech stocks, or emerging market sovereign debt, or EFA stocks or EMA stocks. So, and you go even further. If we can borrow yen at 1% and the yen's not going to appreciate, why don't we buy real estate in Miami, buy an apartment building, and just get higher returns? In this case, you have two risks when you have one of these risk-on carry trades. You have the risk that the yen or the borrowing currency appreciates, and you have a risk that one of these investments fails. Here's one more example of a yen carry trade. In this case, it's the same thing. We are borrowing in yen at 1%, buying a treasury by selling the yen and buying dollars first. We'll still assume that the spot price is 100 yen per dollar. But let's assume that the forward price of the yen is 99, not the 98 that IRP holds, but 99. So what are the profits from this trade? Well, let's go look at our cost and revenue. Our cost in this case is we have to pay back 1 million yen at 1% interest, and the dollar cost of that loan would be 1/99, because in this example, we're going to hedge the 1-year exchange rate by locking into a forward contract. So in a yen carry trade, you just wait a year and see what the exchange rate is. But you can eliminate the risk by just entering into a forward. Just as you buy the currency, you can enter into sell the yen and buy dollars, you enter into a forward contract to buy it back to pay off your loan next period. So if we use the forward price here, we see that our cost is 10,202. Now our revenue is going to be the same as we take our 1 million yen, buy dollars at the spot market, and then invest in a U.S. bond. In this case, we have a profit of $98. Now this example here is a carry trade. Again, we're borrowing one currency, selling that currency, investing in another country's bonds. But the thing here is we're entering into a forward contract to eliminate your foreign exchange risk. In this case, when you have covered your exposure to an appreciation of the borrowing currency's exchange rate, we can now call that covered interest arbitrage. And that is a carry trade with a forward contract on the final purchase of or sale of the foreign currency. So that's a carry trade.